Ever feel like you're swimming in economic data, trying to figure out what actually matters? Well, today, we're going to cut through all that. We're taking a deep dive into the latest Market Pulse report. It's from June 2025, and it's absolutely packed with the latest global and domestic economic indicators.
Yeah, everything from trade tensions, central bank moves, inflation, industrial stuff.
And of course, India's own growth story, which has been pretty compelling. So our mission today is really to unpack these sometimes mixed signals, understand the surprising shifts, and connect the dots for you. The goal is for you to walk away with a much clearer picture of where things stand, both globally and right here in India.
Sounds good. And it's amazing how fast the global picture can change, right? Yeah. I think what immediately jumps out from this report is a pretty significant de-escalation on the trade front. That's certainly making waves.
You're absolutely right. I mean, that is a genuinely positive development, isn't it? The U.S. and China, after all that tension, they've actually agreed to cut tariffs pretty dramatically. For U.S. goods, tariffs are down to 55%, which is nearly half. And for Chinese goods, they've plummeted to just 10%.
Yeah, that's a huge shift.
What's the wider impact of something like that?
Well, it's significant.
Well, yeah.
And on top of that, China also agreed to temporarily resume exports of rare earth minerals to the U.S. It's under a 6-month licensing deal, but still, that offers some immediate relief for global supply chains. Could ease some price pressures down the road.
Okay.
But, despite this positive turn, the broader outlook from the major central banks, think the Fed in the U.S., the Bank of England, Bank of Japan, it still seems quite cautious. They pretty much adopted a wait-and-watch approach, held interest rates steady in their latest reviews.
And it's interesting, isn't it, that the full inflation impact from those earlier tariffs, well, it's probably still working its way through. Companies were front-loading imports to get ahead of the deadlines. We even saw that contribute to the U.S. Q1 GDP number, which contracted slightly, right?
Yeah.
5.2%.
Exactly. That front-loading definitely played a role. And this cautious stance of the central banks, it really highlights the ongoing global uncertainties. They specifically pointed to heightened tensions in the Middle East and just the evolving situation with U.S. tariffs as key risks they're watching.
Okay, so if we look at global activity, say, through the PMI data, what's that telling us?
Well, the Purchasing Managers Index insights show weakness mostly centered in manufacturing. Production there actually slipped back into contraction territory,
Okay.
but the service sector continued to show pretty healthy growth in business activity. So a bit of a divergence there.
Manufacturing slowing, services strong. And here's something I found fascinating. Manufacturing confidence, specifically the future output part of the PMI, it actually bounced back quite strongly right after that U.S.-China tariff deal was announced.
Yeah.
Really shows how quickly sentiment can pivot on policy news, doesn't it?
It absolutely does. And that brings us nicely to India's economic picture.
Yeah.
Which is, well, it's a really interesting mix of resilience alongside some areas that are moderating.
Okay, let's start with the positives for India.
Right. First, big one.
Yeah.
Inflation relief. Significant relief.
Yes. Headline retail inflation, it kept softening. That's 7 months in a row now. It dropped to a surprising 2.8% year-on-year in May.
Wow.
I mean, put that in perspective. That's a level we literally haven't seen since March 2019.
And what's driving that mainly?
It seems largely due to sustained deflation in food prices.
Yeah.
Vegetables in particular were down a huge 13.7% year-on-year. Pulse is also down 8.2%.
Okay, that's a big help for household budgets.
Definitely.
What else is looking positive?
Well, the monsoon outlook is quite optimistic. The IMD, the Indian Meteorological Department, they've pegged the southwest monsoon for this year as above normal.
Okay, what does above normal mean in numbers?
It's forecast at 106% of the long period average, the LPA, so better than the long-term average. And even though there was a tiny rainfall deficit early on, reservoir levels are actually higher than last year. And early sowing of kharif crops has outpaced last year, too. So all that looks really good for the agricultural sector, potentially better rural incomes.
That is encouraging. And anything on the external front? Buffers.
Yeah, absolutely. India's forex reserves have been rising. They hit an 8-month high, nearly $700 billion by the end of May.
It was $691 billion.
Right, $691 billion. And that gives us a really substantial import cover, 11.4 months, makes India much less vulnerable to, external shocks.
Okay, so those are some strong positives. Inflation, agriculture looking up, solid forex buffer. But as you said, it's not all one way. Let's pick it now to where we're seeing some maybe moderation or even weakness.
Right. Industrial production is one area. The IIP growth, Index of Industrial Production, it fell to an 8-month low, just 2.7% year-on-year in April.
Okay, that's a noticeable slowdown.
Yeah. And core sector performance, which covers those key infrastructure industries, that also stayed pretty subdued. A 9-month low of only 0.7% year-on-year growth in May.
What was dragging that down?
Mostly sectors like fertilizers, electricity, natural gas, and crude oil. Mining even contracted slightly by 0.2%, first decline since September last year.
Okay, so industry definitely showing some softness. What about the PMIs in India?
They also showed that kind of mixed picture. PMI manufacturing moderated a bit in May. Softer new orders and production, still expanding, mind you, at 57.6, but slower.
And services.
PMI services held firm, 58.8, seemed to be supported by pretty robust international demand.
Interesting. Okay, another area you flagged was credit growth.
Yeah, bank credit growth seems to be losing some momentum. Outstanding credit grew at 8.6% year-on-year. That actually dipped below deposit growth, which was 9.9% as of May.
Right, so the credit deposit ratio moderated.
Exactly. And that seems to reflect maybe weaker urban demand, also perhaps subdued private corporate capital expenditure. We saw a broad-based moderation across loans to services, industry, agriculture.
But there was an exception.
Yes, the exception. Personal loans. They grew quite healthily, 11.8% year-on-year. And notably, loans against gold jewelry just surged.
Okay, so people are borrowing personally, maybe using gold as collateral, but businesses are maybe holding back a bit more.
That could be one interpretation. And this ties into external trade, too, which also showed weakness. Both merchandise exports and imports contracted slightly in May, year-on-year.
Okay.
And here's one of the surprising little nuggets. Despite the overall drop in imports, if you strip out oil and gold.
Non-oil, non-gold imports.
Yeah, they actually rose quite notably, up 11.7% year-on-year.
Huh. So that suggests some underlying domestic demand is still quite firm, doesn't it? Even if overall imports are down?
It could, yeah. But then you look at high-frequency indicators for urban demand, like passenger car sales. Down 6.0% year-on-year. And two-wheeler sales down even more, 11.8%. That really points towards muted urban demand.
Which contrasts with the potentially stronger rural picture we discussed earlier, thanks to the monsoon outlook.
Exactly. A bit of a divergence there, too. Okay, let's shift gears because this is where the policy action gets, well, truly fascinating. The Reserve Bank of India, the RBI, delivered what people are calling a trifecta of surprises. 3 big moves.
Right. Let's break them down. Surprise number 1.
The steep rate cut. The MPC, the Monetary Policy Committee, they decided to front-load their monetary easing, cut the policy repo rate by 50 basis points.
0.5%.
0.5%, yeah. Down to 5.5%. That's actually the biggest single cut since March 2020.
Wow.
And it brings the total cuts since February this year to a full 100 basis points, 1 full percentage point.
Okay, that's a pretty bold move. What was the thinking behind cutting so much now?
Well, the MPC statement said they derived comfort from a sharp and broad-based decline in inflation. Basically, that good inflation number we talked about gave them room.
Right, the 2.8%.
Exactly. And they also cited rising downside risks to domestic growth, especially from that global trade uncertainty.
Okay, makes sense. What was surprise number 2?
The stance shift. They changed the policy stance from accommodative to neutral.
Ah, interesting. So accommodative usually signals more cuts are likely, shifting to neutral. What does that imply?
Well, it signals that while the RBI is still committed to supporting growth, there's probably limited room for more rate cuts after this big one.
So maybe don't expect another 50 BPs cut next time.
Probably not. It really emphasizes a data-dependent approach from here on out.
Yeah.
They'll watch the numbers and react rather than signaling a long easing cycle.
Right, got it. And the third surprise, the trifecta.
The third surprise was a cut in the cash reserve ratio, the CRR. They cut it by 100 basis points, a full percentage point.
Whoa, a CRR cut too? That's significant. Down to what level?
Down to 3%. That's a level we last saw back in April 2021. And they're phasing it in 4 equal steps between September and November this year.
Okay, cutting the CRR by a full percentage point. That injects a lot of liquidity into the banking system, doesn't it?
It does. The estimate is it will add nearly Rs 2.5 lakh crore. That's about, US $30 million equivalent of durable liquidity by the end of this calendar year.
So what does that extra liquidity achieve?
Well, fundamentally, it makes more money available for banks to lend out. Could mean more accessible loans, maybe cheaper loans eventually. It helps fuel activity. And it also helps the RBI manage its own books, helps unwind its short forward position without tightening liquidity too much. And crucially, it's expected to strengthen monetary policy transmission.
Meaning the rate cuts should flow through to lending rates more effectively.
Exactly, hopefully boosting credit demand.
Okay, so three big moves. Big repo cut, stance shift to neutral, significant CRR cut. How did all this affect their forecasts?
Right, the forecasts. They slashed their FY26 inflation forecast, the CPI forecast, by 30 basis points, now expecting 3.7%.
Wow, below 4%.
Yeah, and the cuts were particularly steep for the near term. Q1 forecast cut by 70 basis points to 2.9%, Q2 cut by 50 basis points to 3.4%, shows real confidence on the inflation front.
But what about growth? Did they raise the GDP forecast?
Interestingly, no. They retain the GDP growth forecast for FY26 at 6.5%.
So despite the easier money, they're not expecting faster growth than before.
Seems not. They believe domestic resilience, improving investment, and that continued government push on infrastructure will be enough to maintain that 6.5% pace.
Okay, and what about liquidity in the system now, before the CRR cut kicks in?
Well, conditions have actually flipped quite dramatically already. We went from an average deficit of about Rs 1.2 lakh crore earlier in the year
February to April, yeah.
to an average surplus of Rs 1.6 lakh crore between April and June. That's thanks to various RBI measures even before the CRR cut.
Right, and the call money rate.
The weighted average call money rate, WACR, that softened too. Reflects easier conditions in the money market.
Okay, so summing up the RBI's moves, quite a package.
Definitely. So what does this all mean for you listening?
Well, the big focus now shifts squarely to transmission. How effectively, how quickly will this significant monetary easing actually filter through the economy? And of course, future RBI actions will really hinge on how inflation actually behaves from here and how those global risks evolve.
Absolutely. Which brings us to the broader growth story for India. Its resilience has been pretty remarkable, especially considering the global headwinds and some of the structural shifts happening.
Yeah, let's talk GDP. Q4 of FY25, the last quarter, growth actually accelerated, hit a four-quarter high of 7.4% year-on-year.
That was a strong beat, wasn't it? Consensus was expecting something lower, around 6.7%.
That's right, comfortably beat expectations. And what drove that strong performance?
Primarily, it seems, surprisingly strong investment demand. Gross fixed capital formation, GFCF. That grew by a really robust 9.4% year-on-year. Wow, a six-quarter high for investment growth.
Exactly. And it was also helped by record-high quarterly net exports.
Okay. But was anything holding it back?
Yeah, it was partly offset because private consumption didn't expand quite as much as some had hoped. And government spending growth actually slowed quite significantly, hit at a 15-quarter low.
Okay. What about the supply side, the GVA?
Gross value added, yeah, that rose by a solid 6.8% year-on-year in Q4. And it was pretty broad-based.
Across sectors.
Yeah. Agriculture saw a healthy 5.4% increase. Industry was up 6.5%. And construction within that was notably strong, 10.8% growth. It's been averaging around 10% for the last 2 years, actually.
Impressive consistency in construction.
It is. And services grew strongly, too, 7.3%, particularly public administration, financial services, real estate.
So that's the quarterly picture. What about the full year, FY25?
Well, the provisional estimate for GDP growth for the full financial year 2025 has been kept at that strong 6.5%.
Oh.
Now, nominal GDP growth, that eased a bit to 9.8%, a four-year low. But that reflects the benign inflation we talked about.
Right. Low inflation means nominal growth is closer to real growth.
Exactly. But the key takeaway remains. India is still, emphatically, the fastest-growing large economy in the world.
And what were the main drivers for that full-year growth?
For FY25 as a whole, it was driven by strong private consumption, which grew 7.2%. Also, buoyant services exports, they really helped lift overall export growth to 6.3%, and robust investment demand, up 7.1%.
Okay. Now, if we zoom out a bit, the national account statistics for 2025, they reveal some interesting longer-term structural shifts, right?
They certainly do. A few key things stand out. First, the post-COVID recovery has been significantly led by investment, particularly government capital expenditure, which has laid a strong foundation.
Okay, investment-led. What else?
Second, there's a really noticeable shift in household consumption patterns. People are spending relatively less on essentials like food and clothing and more on services.
Like what kind of services?
Spending on health, education, transport, those have increased notably. It really signals, rising income levels, increasing urbanization, a maturing consumption economy overall.
Interesting. But what about savings and debt?
Right. Household gross savings have actually risen. But, and this is important, net financial savings have declined
Why the decline in net financial savings?
because there's been a sharp rise in financial liabilities, basically, borrowing. The household debt to GDP ratio has climbed quite a bit. It reached 42.1% in FY24,
Awesome.
up from 35.7% back in FY20, before the pandemic really hit. So a significant increase in household debt.
Okay, that's definitely something to watch. Any shifts within industry itself?
Yeah, the data shows high-value manufacturing segments, think pharmaceuticals, transport equipment, electrical equipment, they've shown strong growth. But others, like textiles and food processing, have kind of underperformed.
Okay, so a dynamic picture even within manufacturing.
Definitely.
So putting it all together, what's the outlook for FY26, the current financial year?
Broadly, the expectation is that India's economy will remain pretty buoyant,
Supported by what, mainly?
supported by that continued government emphasis on capital expenditure, a strong agricultural output, hopefully, thanks to the good monsoon.
Which should help farm incomes and rural demand recover.
Exactly. And then you have the easing inflation and those declining interest rates, which should provide a further boost, particularly to urban consumption.
Seems like a positive setup domestically.
It does look strong domestically, but, and this is the crucial caveat, we can't ignore the headwinds from outside.
Like what?
Well, potential global trade disruptions, ongoing geopolitical tensions, and always the risk of weather-related uncertainties. They continue to pose downside risks to this otherwise optimistic outlook.
Right. Always have to factor in the external environment. Okay, so you've just completed this deep dive with us into the latest economic pulse. We've uncovered how global trade shifts, central bank caution, and India's own bold policy moves are shaping the macro picture.
Yeah, we've seen a resilient Indian economy, definitely adapting to challenges.
Yes.
Surprising strengths in areas like inflation management, investment.
Even as certain sectors clearly face headwinds and there are divergences like urban versus rural demand.
Exactly, it's a complex picture.
So thinking about the future and what this means for you, here's something to perhaps mull over. Given that clear shift we talked about in household consumption towards services, combined with that rising household debt, how might those two things, intertwined as they are, reshape India's domestic demand story in the coming years? And what hidden opportunities or maybe challenges might that create for different sectors of the economy?
That's a great question to ponder. The changing shape of the Indian consumer and their balance sheet, definitely key for the future.
Something to think about as we watch this dynamic economy continue to evolve.